Is Australia's interest rate differential driving a lower Aussie dollar? Hi, everyone, and welcome to another episode of Insights, brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we have Alex back on board to discuss more of the bigger picture issues around mismatched interest rates between here and around the world, a topic she's very knowledgeable on. But more importantly, how differences between Australian and US context have been unfolding exactly pretty much as she's been predicting. And what that means for us going forward. How are you going today, Alex?
I'm going very well. I have power back on at home, so we're winning now.
Excellent. Yeah, I know that sort of slowed you down a bit earlier today. Power is important.
Yeah.
The news piece today, an interesting bit of history. There's lots of stuff in there actually to unpack. I thought it was good because it continued a discussion that we've been having around bigger picture issues like interest rates and fiscal policy as well. But it sort of took it down a slightly different angle. So I'd like to start today, if we could, talking about some of the overview of the differences between how monetary control works in the US and Australia, because that really sort of sets us up for what we need to talk about today.
Yeah, so I guess, when you listen to the Fed talk and you listen to the RBA, they are very different. The Fed likes to talk about how it needs to drive unemployment down to get wages down, whereas the RBA constantly, all it is mortgages. So the chat there is mortgages. And the reason they are so vastly different is because the products that are offered. So in the US, 90% of mortgages are 30-year fixed rate mortgages. So if the Fed raises interest rates, it doesn't affect people immediately. Consumers are not affected. They
So
have
90% of people wouldn't even really care so much now.
not even flutter an eyelid.
Right.
So I guess if you're upgrading houses, that's a bit of a different story. But as is, they're not going to flutter an eyelid. Whereas in Australia, it is all anyone talks about. And it's, what Lowe is being grilled about at the moment is how can you be doing this? Well, monetary policy, because of the differences in products, in particular for consumers, is what, they're trying to drive consumer spending down. But America's doing it by trying to control unemployment and wages, and Australia controls it by taking money away from people through their mortgages. So they're very different.
And you could probably argue that it's actually more effective here, that policy in what you've just said. Like, so if you raise those rates, it has an immediate and ongoing impact on people, or maybe not immediate, but within a couple of months, it certainly does. Whereas in the US, it's not anywhere near the same, is it?
No, and the differences are, I mean, look at the consumer spending in the US right now, it's going up. Australia is falling off a cliff very rapidly. So so they're totally different control mechanisms, but it's the only way you can fight inflation. But yes, you're right, one's more effective. The other one is less effective. It works for businesses and employment and government spending. Which is not the same in Australia. And being out of step with the US, that the mechanisms are different, is really what's going to start causing some pretty big currency differentials, as well as possibly inflation, if we don't get a handle on this pretty quickly.
Right. And we'll certainly dig into that a little bit more in a second. But can you just go back? Because I found this fascinating in the news today, a little bit of the talk of the background or the history, the roots of why this difference exists. So I know there's sort of a bit of history around the Depression and the GFC and how the US got to being in a situation that's quite different to where we are here.
So I started out in finance, probably 2 or 3 years before the GFC and all the subprime loans. I remember hearing about it all. And I remember hearing about Freddie Mac and Fannie Mae, but I'd actually never delved into the history of them as well, which we got to do today, which is interesting. So what actually happened in the US during the Great Depression is because there was 1 in 4 houses being foreclosed on. So everyone was losing houses. They had 3 to 5 year loans at that point in time. And so that, to help protect these homeowners, the government invented Fannie Mae, which was basically a mechanism to buy loans from banks. And it's a no recourse loan. So if I buy a house in the US now, my lender lends me money, packages up the loans, sells them to Fannie Mae, and if I want to hand the keys back, I'm not bankrupt. I just hand the keys back and walk away. Or and then it also allows these 30-year loans. So it was all working really well with Fannie Mae and Freddie Mac, which was basically brought in as competition to Fannie Mae in the 1970s. It did not work well during the GFC, which we all know about.
Because there were stories during the GFC of people doing exactly what you just described, weren't there, where they would leave the keys literally in the mailbox and say, we're out because our house is worth less than what we owe. So why would we pay that off? We'll just hand it back to the bank.
That's exactly right. And in falling interest rates, which we've spoken about a lot, the difference between falling interest rates and raising interest rates, mechanisms are completely different. So where that walk away from your home loan from a 9% mortgage rate worked really well for people in America, in Australia, we were on variable rates. So we didn't have the same, we definitely had falling house prices and things like that, but we had bankruptcy laws in place, which meant that you cannot walk away from your house. So not only were our mortgage payments falling to buffer us, you also couldn't walk away. Whereas in the US, they just walked away. Those 9% loans were left with Fannie Mae and Freddie Mac, and the US government bailed them out. But it's fixed itself over time. But we're now in exactly the opposite situation of the GFC. So Australia is not in the position we were in before. We're in the opposite position, which is the worst position this time.
And that brings me to what I was really wanting to dig into, this idea of the fixed interest cliff, because we're starting to hear that pop up in the Australian media quite a bit. So can you maybe tell us a little bit about what that is and why it's something that's particularly relevant to us here, but overseas, I mean, they wouldn't mention it at all for the reasons that you've described, would they?
There is no fixed interest cliff in the US. 2% of loans are variable. 6% are 15-year mortgages and 2% are some variation of it. 90%, 30-year mortgages, you just pay your house off over 30 years and you don't think about it. It's always the same payment. As wages rise and you become wealthier, the payments become more insignificant to you. Whereas in Australia, we've got the variable payments, repayments, and as you know, there's been 9 interest rate rises recently, but we only offer 3 to 5 year fixed rates. So we're going from 2019-20 when rates were really low. Well, we're 23 now, so we're halfway through the longest anyone could lock in for, and realistically, possibly the average of what everyone could lock in for. And they now have to go from 0 to 9% to 9 interest rate changes, whereas anyone who's been on variable has really slowly suffocating through it. So
they've experienced it, but and maybe adjusted over that period of time. Not saying that it was easy, but people have probably adjusted month by month and gone and pulled that belt tighter. But you're basically saying there's people who are going to all of a sudden be hit with a massive shock because their spending hasn't adjusted, and now they're going to have to adjust really rapidly to a very big change in their payment.
Yeah, but this is Australia's problem. It's not the world. It's not the US problem, and it's not Europe to a lesser extent. And everyone is using monetary policy to control this, and they are vastly different in mechanisms.
Yep. So out of this, how does it come together with what you think needs to happen? Because you've made that point that interest rate policy, in some ways, we don't really have a choice over, do we? Because ultimately we have to follow to some degree. How much we can follow is becoming questionable now that the rate's getting much higher. But it's probably more specifically government fiscal policy that needs to step in. So can you maybe talk to us a little bit about what you think needs to happen there, but also how does this tie in with the sort of headline of the article today with the Aussie dollar? Because that ties into this as well, doesn't it?
Yeah, so we've spoken about this a lot. What can Australia do, to stop inflation? Nothing. So if the US keeps raising interest rates, we will just get that inflation. So there is nothing in a monetary context we can do except for keep up, which is ultimately disastrous. So, you know, where the burden in the US is given to businesses and government for spending, and then they equilibrate it, I guess, by creating unemployment through it, because they can't afford people as much, and then wages may not rise as much. In Australia, this equilibrium is just given to one group of people, which is mortgage holders, and it does. If the US keeps lifting, all that is going to happen is we can't, because it's such a small part of or small 30% of people or families, I guess, with these big mortgages that can't afford it. They're suffering, whereas other people, retirees who own their houses, nothing is happening to them. In fact, they're benefiting because their savings are getting more return.
Yep.
So you've got the small minority that's sharing the load in Australia. You've got interest rates rising in the US, forcing our interest rates up, because if we don't raise at the same rate as the US, our dollar will collapse and the inflation will be even worse in Australia. So monetary policy in Australia is all it is going to do is keep up, nothing more. It is going to be as ineffective as anything. And if we don't keep up, there's more inflation. So to tame what will happen, which is more inflation, it has to be fiscally controlled. And that is government spending, that is increased taxation. I mean, Garno's always spoken about it. In these types of scenarios, you might tax everyone a flat 2%. That's retirees, or maybe lift the GST by 5%. That's a flat tax. And put that money back into savings in the government. So that's one way of taming this inflation. I could talk to the cows come home about the energy policies in Australia being absolutely disastrous for
well, I know that's something that you've had a lot of personal experience with, which is why you're so passionate about it.
I'm very passionate about it. So this $12 cap on gas is non-existent. Rather than there being a $12 gas cap, we recently tendered for gas. No one would even give us a price. Despite what the government is claiming as a great policy, $12 does not exist. And not only that, $12 gas didn't exist before the Ukraine war. It was sitting at around $4 to $6 per gigajoule at the time. Well, the rest of the world is now below the Ukraine war. We're claiming a win at $12 a gigajoule, but actually no one will even give you $12 a gigajoule. So energy policy in Australia is disastrous. It has added to our inflation, whereas the rest of the world has now moderated. And the government, quite frankly, is not doing enough to tame what is fiscal now. So it's energy policy, it's flat taxation policy. This is like, they can keep parading low in front of everyone and saying what a terrible job he's done, but his hands are tied by the US.
Yep.
And the only thing that's going to help with this now is anything the government can do.
Which is why they'll be parading him around, as you're saying, because that's the easy scapegoat. But the reality is there's much harder work to be done by other branches.
Yeah, if I'm of the opinion that the RBA can't do much more. So it leaves us only with fiscal mechanisms. China's opened up, so commodity prices like gold should go up. So, it leaves you with those, the mineral resource taxes as well as an option. Yeah. But, mortgage rates should not be the only mechanism here right now, because it's not the same as the rest of the world.
It's not the right tool. And yeah, you've
but
made
it's
that
not
really
the same too.
Yeah, no.
Like the US, I love speaking to my brother over in the US. How's everything going? Great. Everyone's spending, inflation's starting to moderate. Monetary policy is working exactly the way it should be doing in the US right now, and it's not in Australia.
Yeah, and that's something that cannot be solved by blaming the wrong party.
That's it.
Alex, thank you so much for all your work on that today. It's really interesting topic, and you've been spot on with your predictions for the consequences of these policies so far. And we always value hearing the latest updates on how you think it's unfolding, because it really brings some unique insight to it. So thank you very much for that.
Thank you. Hopefully I'm wrong on this one, though.
Well, yeah, we always hope you're wrong, but that's the problem. You tend to be quite correct. So we'll carry on. Thanks also to everyone for watching. Remember, you can reach out with questions, comments. I know, there's probably some comments about Alex's 15% GST comment there. So that's always going to spark a little bit of interesting debate. But reach out on the social platforms and we'll do our best to respond to those. I'll be back next week on Monday with the next episode. So until then, good luck out there in the markets, and we'll talk again soon.